Hey troops, good afternoon. Today is Friday, January 31st, and while generally I try to keep politics out of these economic updates and market commentary videos, sometimes it's just plain unavoidable, and today is one of those times. You can choose to agree or disagree with me on this, but it is my opinion that the entire face of the planet changed several weeks ago with the outcome of the election, and that all the economic and geopolitical risks that we were previously concerned with are now all starting to melt away. It appears that the new administration is tackling some of the greatest challenges to America's success in a more meaningful sense than previous administrations have done. And it's my opinion that moderately aggressive investors should probably be fully invested right now. And of course, if you would like to review your portfolio or discuss, please don't hesitate to reach out. Of course, we'd be happy to help. Last week, the S&P closed at record levels, which is exciting. But what's more interesting is that the breadth of the market rally has improved dramatically. Previously, we've seen that the majority of growth was centered around the Magnificent Seven stocks, Facebook or Meta, whatever they call themselves these days, Alphabet, Tesla, Nvidia. But these days, the advanced decline line has seen more trading volume in stocks that are going up. In other words, while the Magnificent Seven represents 7 of the largest stocks on the S&P 500, previously the other 493 companies on the S&P 500 weren't doing so hot. Now we are seeing that trend changing where the Mag 7 is starting to slow up and the rest of the S&P is starting to pick up steam. The announcement last week of the Deep 6 new AI tool from China over the weekend will likely have an impact on technology in the semiconductor industry for now. But here's what's interesting. The technology sector has been moving sideways since last July and may have lost momentum some time ago. Long story short, technology and semiconductors have not been that attractive for some time, and we believe that industrials, blue chip, domestic American dividend-paying blue chips are likely where the action is and will continue to be for the near term. President Trump has made it clear that he would like to return industry and manufacturing to America, and it appears that we are seeing that process in motion today as industrial-oriented investments seem to be benefiting. No doubt, we have challenges still ahead, the most notable of which is the national debt and budget deficits. It's absolutely out of control, and now with the election behind us, because no one wants to talk about deficits and debt during an election, we are now seeing that topic move forward into the national conversation. If you happen to follow Twitter or X or whatever it is it's now called, you will see that Elon Musk and DOGE, the Department of Government Efficiency, has made it abundantly clear that America is heading towards de facto bankruptcy very fast. I'm optimistic that the new administration is working towards fixing that, but frankly, it will take massive effort in the form of reduced spending and increased taxes to do so. And here's the big one. We believe the new administration will try to extend the previous Trump-era tax cuts. Trump has already indicated that he would like to make them permanent. As of now, those tax cuts are set to expire at the end of 2026. And while we do believe they will likely be extended a few years, in the end, Trump does not set the tax law. Congress does. Plus, we still have $36 trillion of national debt and rising, and most economists and all the people we follow that think about this stuff all day long all agree that we cannot meaningfully reduce our national debt without some level of increase in taxation. There is a case to be made that when taxes are low, people settle up their tax debts more readily than if taxes are high. A recent report from the Committee to Unleash Prosperity suggests that corporate tax revenues have been higher over the last 4 years with the Trump-era tax cuts because tax rates are lowest. That's why, as an office, we are engaged in a practice-wide effort of helping clients understand the benefit of Roth conversions on their retirement assets. And yes, that means pay taxes now. but at a known and controllable rate rather than a future, unknown, uncontrolled, and possibly higher rate. Multiply that times all the people in America that understand this stuff, and it's possible to imagine a large inflow of tax monies that could help reduce the national debt while tax rates are currently low. The question becomes, how long can that inflow of additional tax money last before it runs out of fuel or before taxes simply must go up? In the end, we believe it makes sense to accelerate taxation via Roth conversions, and we believe that other folks will see that wisdom and will continue to do so, and we continue to advocate that for now, at least until it no longer makes sense to do. Breaking down briefly some of the policies the new administration is proposing, let's start with tariffs. And I know that for a lot of people this one is problematic, and I get it, I understand that. It's also a large point of contention with many economists who note that adding tariffs may be inflationary by causing the cost of goods to increase. But that's only the first step. In my opinion, a lot of folks are not seeing the second step, where that second step is using tariffs as a negotiation tool. Look, nobody wants a trade war. But it's my belief the policy of this administration is to use tariffs as a negotiating tool where in the long run we will end up seeing fair trade practices, or at least less not fair trade practices. Some of you may remember Ross Perot, presidential candidate back in the 90s, and one of his platforms for presidency was the giant sucking sound of jobs that would be created as industry moves out of the United States to Mexico and Canada, and that has pretty much come true. The Economic Policy Institute concluded that lost U.S. jobs of about 850,000 jobs from 1993 to 2013 as a result of NAFTA, and that number has undoubtedly risen. The new administration's policies seem to recognize and want to reverse that direction with an inflow of new foreign capital and a restoration of industry and manufacturing in America. And let's talk a little bit about DOGE and government spending. While it may be difficult to identify exactly how much wasteful government spending is out there, there's probably a lot. And we've all heard stories of $35,000 toilet seats on military aircraft, and more recently $50 million for condoms in Gaza. But if you're following some of the commentary that is coming out of the DOGE committee, there's reason to be optimistic here. The DOGE committee seems to feel that government expenses could be cut in half. And we take that reduction in spending to add to an increase in economic output, and we may be closer to closing the budget deficit. Although that has not meaningfully yet addressed the national debt, I'm excited to see there's now a section on the national debt clock that is tracking the amount of money saved so far by DOGE. Current reading is $34 billion, and that's a good start, but we still have a long way to go. Finally, what's up with interest rates? It appears the stage is set for an epic battle in Washington over interest rates in the years ahead. Tax cuts and deregulation stand to boost business spending, and a clamping down on government excess could slow the deficit spending as well. There's also propped up economic growth, and we'll be watching the M2 money supply. As you may know, the growth of the money supply can be one of the greatest contributors to inflation. So, if the money supply remains modest or goes down, both inflation and economic growth may slow, which may give the Feds more room to continue to cut interest rates. We know that President Trump would like to see an interest rate cut, but I doubt that he will be able to influence the Fed enough to do so without appearing to kind of break the required separation between the Fed and the president. And while the Fed has shown an active neglect of the warning signs that would have preempted this inflation debacle to begin with, I have my doubts that they will suddenly get religion and get on the bandwagon now. Let's remember, the Fed's balance sheet has grown about 700% since the start of quantitative easing back in 2008, and it seems that it has done so with very little oversight from Congress, the White House, or the press corps. I'm optimistic. that with a renewed engagement from the President and his administration, we will start to see a more involvement from Congress, the media, and everyone to better manage the Federal Reserve. In the end, I'm optimistic that we are headed into a period of market growth with a strong mandate for change that could last for quite some time. And with that in mind, we would encourage investors to make sure that their portfolios reflect their opinion of the world today. And as always, if you would like to discuss, please don't hesitate to reach out. And as always, thank you for your continued confidence in the work that we do. Thank you.